Is it all right if we start? Okay.
Thanks. As our first bank of the day, we'd like to welcome Ponce Financial Group. The bank is a $2.6 billion New York City-based institution that completed its second step conversion almost 2 years ago. I think almost pretty close to the date. PDLB is the symbol. Its management has a variety of growth initiatives in place, and it will be interesting to learn more. We'd like to welcome Carlos Nauden, President and CEO, Sergio Vaccaro, Executive Vice President, CFO, and Frank Perez, Executive Vice President and Chief Investor Relations Officer. So, do you want to go through part of the deck with us first, or?
A little bit, not that much. We'd rather get more into, the Q&As. I think that's probably more helpful. But just in case some folks don't have, the background on us, let me just very quickly. Who's got the deck? You do, Ian?
Sorry,
Anyway.
I have it. Or Sergio, would you prefer to? Okay.
Okay.
All right. So,
and for our audience, we've posted the one pager in the chat.
yes.
I think, Julian, you have to allow me to share.
Okay, and so after you walk through the slides, we'll all come back on for Q&A.
Yes, and we'll do it very quickly.
Take your time.
Okay.
Do you see your button yet?
Yep.
Okay.
Now I do. Can you see the screen?
Yes.
Yes. If you want to enlarge it to fill up the screen. There we go.
We're good?
Yes, great. Thank you.
Okay. The usual cautionary statements. I won't make them, obviously, but as Ian said, we are a second step mutual conversion. We also a recipient of ECIP, the Emergency Capital Investment Program of the Treasury Department. We have 225 million perpetual preferred stock. We have shown significant organic growth. We are an MDI and a CDFI that provides access to us for lower cost funding opportunities as well as outright grants. And we are focused on the underserved and underbanked markets in New York City primarily. Go to the next couple. The next one. So we started in 1960 in the Bronx, largely by Latino business people and community activists as a mutual institution. Until 2015, where growth was purely organic and retained earnings, we grew up to 700 million and had 13 branches. In 2015, I became the president of the bank. My background with the bank goes back to the 1980s. I was their outside regulatory counsel and strategic consultant. We, in that time period, since 2015 to the end of 21, we became a certified SBA lender. We continue to focus on residential and multifamily properties. We continue to focus on the Latino markets and the African American markets and the immigrant markets, and we became both an MDI and a CDFI. At the end of 21, we had grown to 2.3 billion. In 2022, we did a second step conversion and largely focused on the fact that the ECIP, if you were a mutual holding company, you got debentures, subordinated debentures, which you had to repay. But if you were a fully converted thrift, you would get perpetual preferred stock. So it was, to us, a no-brainer. So between the 225 in preferred stock and the 123 million that we got in the second step, we considerably bulk up our capital, and today we have almost $500 million in capital. The next to our vision. Sergio, next one. So our growth objectives are really based on trying to get more leveraging on our low-cost capital. We try to continue to utilize the MDI and the CDFI statuses and focus that also on ESG, as that is a very important portion of our business focus. The financial strength that we have is in our geographic focus, but we have to diversify a bit our geographic focus. So, but in essence, between the end of 21 and today, we have grown almost $1 billion in size, 600 of that being securities that we acquired in August of last year. So you'll see the numbers reflect the fact that a lot of those securities are higher yielding than those acquired that anybody had acquired in the 2, 3, 4 years earlier than that. So Frank, you want to just go through our next couple of slides on MDI, CDFI, and ESG? And then Sergio will run us through some numbers after that.
Okay. So Carlos touched on the CDFI and MDI status. We're one of 32 banks in the country with both designations. Couple of stats. Carlos already talked a little bit about the MDI and the CDFI. If you look over to the right, top right hand of the screen, in terms of the rankings out of the CDFI banks in the country, we're first in terms of housing focus. We ranked number 2, and this is out of the top 20 CDFI banks in the country. We ranked second in DLI HMDA as a percentage of housing lending in low to moderate income communities. And we ranked 7th in total assets, total loans, and in the percentage of branches in LMI areas. As Carlos mentioned, as a CDFI, we were accepted or we were honored with a $225 million ESIP capital infusion from the U.S. Treasury. That capital for the first 2 years comes at zero cost to us, and it has incentives after those 2 years to reduce that. Oops, sorry. It has incentives to reduce that amount. The max amount of the rate that it would come up to would be 2%. Throughout our life as a CDFI, we have won awards and mandates for our community involvement, and we continue to be one of the largest and most housing focused CDFIs in the country. Next slide. As a minority depository institution, again, Carlos talked about that as well. There's over 140 minority depository institutions in the country. In aggregate, the MDIs hold about $350 billion in assets. In terms of rankings, as of the second quarter, the third quarter numbers are not out yet. But in terms of rankings, as far as assets go, we are the 20th largest out of the 147 MDIs in the country. And in the New York area, we're the 3rd largest in assets. Okay. We can move on to the next one, Sergio. ESG, there's several things that we've been doing as far as ESG. We've actually published our first report, which you all can find on our website under Investor Relations. I'll just touch on a couple of these as they relate to ESG. When we first took the first step, we created the Ponce de Leon Foundation with the first step back in 2017. Since then, we have made donations of over $1 million to charitable organizations. We have over 300 volunteer time hours that were donated to nonprofits in 2022. As I mentioned, I had to mention this earlier, but over 70% of our lending activities, or in other words, 70 cents of every dollar that we invest go to our low to moderate income communities. So that's some of the highlights as far as ESG. You can see down there at the bottom, poncebank.com, under Investor Relations, you can find our 2022 ESG report. Thank you.
Great. Thank you, Frank.
Thank you.
So just
second.
yeah, I'll just cover a few highlights from the quarter. I know we want to get into Q&A, so I'll be brief. So 2.6 million net income for the quarter, 12 cents a share for the 3 months ended September 30th. Loans grew significantly during the year. We're at 1.8 billion at the moment, almost 20% increase since December. We also saw some deposit growth. We're at 1.4 billion as of September, almost a 12% increase since the beginning of the year. We did shore up our cash position. We have pretty strong liquidity as well as capital. Since March, in particular, since early March, we started shoring up our cash position, $117 million in cash as of the end of the quarter. We continue to keep ample sources of liquidity, and at this moment, we were able to take advantage of the bank term funding program. So cash we keep at the Fed yields more than that program. We can prepay with no penalty, as you might know. So it just made sense to do it. One more comment on liquidity. If you take our liquid assets plus our borrowing capacity, we are at around 700 million, which is more than 2 times our uninsured deposits. So our uninsured deposits are 334 million. And again, we have liquid assets plus borrowing capacity of twice that amount. As a CDFI, we were able to get different sorts of grants. We got one pretty significant in the third quarter. We got another one of almost $500,000 in the fourth quarter. Last 2 comments, not on the page, but I think important to note. We completed our share buyback during the quarter. 1.2 million shares at an average price of 8.9, roughly a 20% discount to book value. And even if we were to look at book value, including fair value marks, we were able to purchase that at a pretty accretive rate for shareholders. And again, we will continue to use all options available to us in the future. In terms of total capital at the holding company level, total capital ratio of 27%, common equity tier 1 at the holding company level of 25.8. And those are the highlights. We'd be happy to take your questions now.
Okay. Great. So Sergio, you can stop sharing your screen. If that works, and Ian will be there. We go.
Okay, great. So we'll remember everyone, there's the Q&A box. Put your questions in as we go. So as an institution, I'll just start while everyone's sending in questions. You've been quite busy. You've had your buyback. And I'm sure there'll be a couple questions about, when's the next one, I guess. You've, I guess from a shareholder point of view, I mean, we can talk some more, and maybe there'll be some questions about, your options and where they're struck, and you haven't decided that, which I think is a positive for everyone. And I think you've committed to pricing them at a premium so that, that's very shareholder friendly. So we're all quite positive about that. Maybe we could start with one question that I think you've also put behind you, just so all the investors, are on the page, is some of the fintech initiatives. Grain is behind you, and maybe you could talk a little bit about what's your plan and how you see fintech and how you're using fintech now.
Sure, I'd be glad to. In fact, I'm the chair of the CFPB's Community Bank Advisory Council, and there is a discussion next week about payment systems. And as you know, the CFPB issued some proposals to govern, so to speak, regulate the large payment systems. I think that the future in banking is in the payment systems. We have to maintain it. We can't let fintechs take it away. And so, we because of our heritage, we are very much sensitive to cross-border payments, which is not just remittances, but there are many other forms of global payments that I think are important. And so we do have an investment in a fintech that does cross-border payments with Latin America. And we think that that is a growing market, and one that, we are very familiar with because of our customer base. So I think the payment systems side of the house is an important and valuable component for us. I think that it can help both our transactions, but it can also assist us in having undervalued assets, as Julian likes to say. Now, as far as the options and MRPs, those plans, they have built in with premium options, which have to be priced at 10% above the prior day's strike price, so to speak. So we think that aligns well with shareholders, and I like to remind people that I'm the 10th largest shareholder at the bank, and what happens to that stock price and the value of the bank is very important to me personally, and as well as a fiduciary for shareholders.
And I think you get a lot of credit. You should get a lot of credit for that, because that's a very friendly move.
Well, and I just want to point out, it's not typical, so for you to, it's not standard. So I think that it shows a lot, doing it. And I also just wanted to emphasize that what is standard is to immediately give out the free stock and all the freebies as soon as it's voted in by shareholders, and you have not. And there's probably several good reasons, the stock price being one of them. So I just wanted to express appreciation that, that hasn't happened yet, and that you did a buyback before, which is also not standard. So that is also, again, it just shows good faith that you're not, angling to price options below where the depositors bought the stock. So that's it's not standard. It is much appreciated, and we just wanted to say thank you.
Yeah. I'm not sure everybody is thanking me for that, but but yes. I
was going to get to some of the questions. Like, what one of is about the buyback. It was great seeing you completed your first buyback, but with the stock trading as cheaply as it is, with all the capital you have, are you thinking about another one?
We have always stated that we will use every possible capital, initiatives and alternatives that we can do. That was not our first buyback. I think we have done 3 at least, maybe 4. And so, yeah, as soon as we are comfortable and have all of the right input from many sectors that we had to talk to, I'm sure that we will try to do that. But currently, we have no announcement that we can make.
Okay, fair enough. So from let's see. Someone, I guess, around that, which interesting question. Can you walk us through the process in getting buyback approval from the Treasury, given you have ECIP? Does that at all impact the process for getting approvals?
It does. And you have to have a uniformity of views between Treasury and OCC or the Fed, actually, the Fed. And so it makes the process, shall we say, a little more laborious. But as we showed it, we did it before, and there's plenty of precedents.
So turning to your earnings, are you starting to see stability? It seems like you are seeing stability in your net interest margin. Could you maybe walk us through some of the components in terms of where you're seeing deposit pricing, where you're seeing loan demand, and are we getting to that? Are we getting closer to the inflection point?
Sergio, why don't you tackle that a little bit?
So from a net interest margin perspective, obviously we've seen declines. This third quarter, for the second time in a row, we saw increases in net interest income as the incremental volume allow us to offset the loss in margin. I'm not sure I want to be very specific in terms of forward guidance, but I can talk about sort of the dynamics in general. And I'm not going to say anything terribly original here. From a loan demand perspective, we continue to see loan demand, which allow us to be a bit more discriminatory in terms of pricing. So we are finding, in relative terms, pretty good pricing, and you can see that in terms of our interest earning assets evolution over time. The competition for deposits continue, and I'm not sure that it will stop anytime soon. I'm not sure, what the inflection point is going to be in terms of competition for deposits. Again, we have seen deposit growth during the year, which is a good sign. Hard to see how that continues in the future. What our job is, obviously, is to continue to think about loan pricing, and if we were to grow the loan book, make sure that we have appropriate funding and at a reasonable cost. So it's something that we're looking at it every day. Obviously, ALCO, we used to meet every week and discuss those topics. So that's as much as I can say.
I think that if you look at our numbers, you'll see a little bit of a balancing act between higher yielding, shorter term loans and the use of the deposits that are higher cost deposits, but that has still some margin on it. So that's why you're seeing the percent of margins reducing, but the dollar of margins increasing.
All right, okay. Here's an interesting question for those in New York who are seeing that the Bronx is really becoming developed in quite an interesting way. So tying this in with overall credit quality trends that you're seeing and values, underlying collateral values, this person was wondering if the Bronx is becoming overbuilt, and is there going, and I'm not familiar with this, but the question was that Queens got overbuilt, and what happens to your low and moderate income consumers and customers in those markets?
Well, it's an interesting question, and the answer I can give you is that most of the construction loans that we do have affordable components to it because they are tax abatements. So there's actually the overbuilding that has occurred has really been a more pricey condos, and those are still predominantly in Midtown Manhattan and a little bit south. I think we're only doing one condo building in Astoria, for example, and all the other stuff is all rental with affordable components on it. So I think that there is gentrification occurring in some of our areas. That is something that is occurring, but that gentrification is largely, I would say, immigrant based. So it's an interesting dynamic that is occurring. I can tell you, for example, that in our headquarters, when we built it 20 years ago, it was pure Puerto Rican. 5 years ago, it was largely Mexican with Puerto Ricans. And today is about 60% Bangladeshi in the period of very short times. So the dynamics of the Bronx and the dynamics in Brooklyn, I live in Brooklyn since the 70s, the same thing has occurred. And I guess my last thing is I would say that Queens is not overbuilt. Unfortunately, there's still, well, fortunately, I should say, there's still a lot of development that's going on there. And we think that the economy of New York is highly unusual and not reflective of what's happening in the rest of America. And I think that is good for us. Our loan to deposit ratio is high, but our loan to value ratio is very low, which is equally important. We hover around 56%, and many of the construction are done at less than 50%. And so we think that because of the rent stabilization that occurs in New York, with the rent, the tax abatements that you get with affordable housing, it makes for very stable commercial real estate, which is, obviously a concentration for us. So.
Yeah, that's another question, digging deeper into the multifamily, that prices, the terms 5 to 10 years ago was sort of, for 5 to 10 year duration was something like 3 to 4%, no personal guarantees. What are the terms today for new multifamily loans? What are the cap rate assumptions?
Well, we don't believe in having no personal guarantees. That is an exception to policy, and we don't like that exception. I think that people have to recognize that we do 5-year adjustable loans mostly. And so the concern that people have is that, okay, rates have gone up, something is repricing, and now the cash flow from the building isn't there. That's not the case, because you have had rent increases for 5 years. They've been doing 2% and 3%, some years 1%, but in total, the increases in rents have been will more than offset the increases in interest rate increases that are occurring as they reprice. The other thing is, which I'm not happy about, the interest rate curve, the inflection of the interest rate curve is at the 5-year mark. So it's something that reprices today is repricing at somewhere around 75 basis points lower than we would make a new loan today. And so there is a built-in escalator that helps the funding of us. And cap rates, there's no average cap rate in New York. The cap rate will vary. I give our board members an address, and they will tell me what the cap rate is on both sides of the street, and they will be different. And so it's very hard to calculate that. And honestly, I think the appraisers oftentimes back into cap rates to get the value that they want to get. So we look at cash flows, and that's really the most important parameter that we have.
There's quite a few questions about ECIP, and we'd love to have you maybe do a separate one-off interview just on understanding these programs, and we'll put that up. But I guess the one that would be the most immediate is to see, can you quantify for us the total amount collected or that you've received so far, and how are you putting that to work? Does that just get put, and what rates does it get put? Are there restrictions on the usage and so forth?
There are no restrictions on the usage, and the questions that people ask me is, are you going to repay it, et cetera, et cetera. And there's a provision that's an important provision in the law, not the regulation, the law, that allows the bank, us, to request from Treasury that the ownership of the preferred shares be transferred from Treasury to our foundation. And so going forward, we would like to make the payments of dividends to our foundation, because that would be really well mission aligned and really in many ways add to the value of the institution. So other than that, there's no other provision that would in any way impact how we use the funds, and what kind of loans we make, or if we make any loans. If we don't make any loans, we'll have to pay 2%, still a bargain. And hopefully we can do the kind of lending over the next 8 years, the next 8 years, that will get us down to 50 basis points. But who knows? We that is uncontrolled factor.
We just have a couple minutes left. Julian, did you have anything else that you wanted to, ooh. Just unmute, and then we can do it.
Apologize. Thank you.
Mhm.
Did we get, I wanted to make sure we got to all the questions because I do see a bunch.
Oh,
Libby, go ahead. Yeah.
there was, I guess, related to this previous question was, can we get an update on how much money has been invested? I guess that you had
Invested.
that you received from ECIP.
Well, I can't answer. We don't disclose that, but what we do disclose is our loan book has grown, and it roughly grows 150 to $200 million a quarter, and so you can just do the math, and you're getting over that. But I think that, let me explain the strategy that we employ for ESIP, because I think it's important. We had the second step and the ESIP at total, 400 million roughly. We leveraged that, and then we invested in securities that would reprice and that over a 5-year period, but would also cash flow fairly evenly over that 5-year period, so that we could get 100 million, et cetera, every year to continue investing in loans and all that. And so you see that from our numbers, and we have 600 million securities, for example. And so, that's really has been the approach. We wanted a fairly fast but gradual growth. As you know, when you grow double digits, the regulators come knocking and worry that you're overly risky. And so we have tried to make sure that our strategy, even though it may wake up or kill the canary, that is understood and one that is controlled. And we focus on asset quality a lot and making sure that everything fits the way we like it in terms of our lending policy and practice. Yeah.
Great, thanks. Well, terrific. This was
the only thing I would add, again, just as it was on some of the questions I was seeing in the Q&A, and again, just to tie it back to what Michael was saying before, right? I'm not going to go and give a fair value of the ESIP today, right? But again, in the concept of people speaking to fair value before, it's 225 million perpetuity paying maximum 2%. So again, it can be lower depending on certain conditions, but let's take 2% at it. Obviously, if you were to do that on a market basis, the rate would be 7, 8, 9, 10. You pick whatever you want, right? But if you were to, again, do the math exercise of fair value in something, market value 8%, and with a 2% in perpetuity, you probably get something close to 20, 30, 25%, right? So when you think about fair value and the value that accrues to the common on a fair value basis, that has to be taken into consideration as well. Regardless of, loan marks, are they accurate, are they not? I think the quantum of this benefit from a fair value perspective, I think it's important for investors, shareholders to understand. That's all.
Great, terrific.
Thank you for having us.
Thank you.
Appreciate it.
Thank you
All
very
right.
much.
Take care.